You are listening to The Vocal Technologist. Spoken tech for your ears.
Welcome back. You know, if you're trying to keep up with financial technology right now, it feels less like an evolution and more like, I don't know, a total reset.
It really does. It feels like the whole board is being cleared, potential is out, and proven scale is what everyone's betting on now.
Exactly. And that's what we're going to get into today, this whole theme of the great consolidation. Where's the money actually going?
Right. And how are the biggest players changing their own rules to keep up?
And maybe the biggest piece of it all, how AI is just completely redesigning commerce. Not in some lab, but like right now.
Yeah. And if you look at that consolidation, I mean, the first place to check is always the biggest funding rounds. Capital isn't just spread around anymore.
No, it's creating these gravity wells. Okay, so let's unpack that. I think the clearest example has to be Airwallex.
Oh, absolutely. They just pulled in a massive, massive round.
$330 million, right? And that pushed their valuation to $8 billion.
$8 billion. And what's really striking to me is the speed. I mean, it's a 30% valuation jump in
just 6 months.
Exactly, in 6 months. That kind of acceleration, it just doesn't happen unless you have absolutely undeniable traction, which they do. They're past $1 billion in annualized revenue.
So they're not just a story anymore. Investors are buying real profitable growth.
For sure. And look at what they're doing with it. They're making a huge play for the U.S.
Naming San Francisco a second global HQ, doubling the team here. That's not just testing the waters.
No, it's planting a flag. It's a very deliberate signal that they're ready to take on the U.S. market, which, is the final boss in FinTech. You have to crack the dollar economy.
Okay, so that focus on proven winners. It's not just happening at the company level. It's also showing up in the strategy of some of the biggest VCs, right? Like Tiger Global.
Right. I mean, Tiger basically wrote the playbook for the last cycle, the whole spray and pray model.
Speed and volume, that was their thing.
Exactly. But their new fund, it's a lot smaller, targeting about $2.2 billion. And that's not just a smaller fund. It's a totally different philosophy.
So wait, is this actual discipline? Or is it just, a change they were forced to make because the market corrected?
I think it's mostly the latter, but the discipline is real. They're moving away from chasing long shots and just focusing on the winners they already have.
So who are the winners? Who made the cut in their eyes?
Well, the list is pretty telling. You've got OpenAI, Waymo, Revolut, and ByteDance.
Okay, so what's the common thread there?
It's massive scale, plus a very clear AI advantage. These aren't just big companies. They're companies that are set up to win bigger because of this whole tech revolution that's happening.
So if you connect Airwallex and Tiger, the message is capital is getting serious. It's chasing scale and it's chasing automation.
Precisely. Which brings us right to the heart of the AI conversation. We're really past the theory stage now.
Yeah, we are. Speaking of which, this idea of agentic commerce, it's happening a lot faster than I think anyone really expected.
It's the next big step. We're seeing AI agents starting to, steer the whole customer journey from discovery to actually initiating the payment.
And the interesting part for any business listening right now is that the near term is sort of semi-autonomous.
What do you mean by that?
Well, the agent is like your super efficient research assistant. It does all the hard work, but you, the human, still make that final call. You've got the final say on the money.
Okay, we have a perfect example of this. Instacart.
Right, with ChatGPT.
Exactly.
Yeah.
They were the first grocery partner to launch an app right on ChatGPT. And this isn't just asking for a recipe.
No, it's a full workflow.
It's a full workflow. You can ask it, hey, what should I make for dinner? And it'll not only give you the recipe, but also create the shopping list. And here's the key. It offers an embedded instant checkout right there in the chat.
So you don't have to leave, open the Instacart app, search for everything?
Nope. The agent does it all, builds the cart, and just presents it to you for final approval. That's the future, that connection between a conversation and a transaction.
And this isn't just a consumer thing. It's exploding on the enterprise side.
Oh, the speed is just staggering. There's some data from Menlo Ventures that Project's enterprise AI spend is going to hit, $37 billion in 2025.
$37 billion. That's a 3.2 times increase year over year. It's already 6% of the entire global SaaS market.
It's the fastest scaling software category we have ever seen, period.
And what's interesting is companies aren't building it themselves.
No, they can't. They don't have the talent or the time. The data shows something like 76% of these AI solutions are bought, not built.
Which creates this crazy competitive market, right? I saw that Anthropic has actually overtaken OpenAI in enterprise market share.
Yeah, which just shows how fast things can shift. Enterprises care about different things like security, compliance, stuff like that.
And it's even hitting the most complex back office stuff. Look at Carta's new fund tax product.
A perfect example. They're using AI to automate the nightmare that is the annual tax cycle for venture funds. It just takes out all this friction that used to take teams of accountants weeks to sort through.
It's always about automating that complex, annoying administrative work.
It is. But that brings us to the human side of it. This isn't always about replacement. A lot of the time, it's about augmentation.
Especially in a field like wealth management.
Absolutely. There's a company called Nevis that just raised a 35 million Series A. And their whole focus is building AI tools to lift the administrative burden off of wealth advisors.
Which is a huge problem. I think I saw a projection that the U.S. is going to be short something like 100,000 advisors by 2034.
Exactly. So they need to make the advisors they do have way more efficient.
So the AI does the grunt work, meeting summaries, compliance checks.
Right, all the operational stuff. It frees up the human advisor to focus on what really matters. The client relationship, the high-level strategy. It's an industry where the technology itself is almost shouting about its own expansion needs. That's why sometimes you hear it called the vocal technologist. The need is that urgent.
Shouting and digging. I mean, it's also replacing the foundational plumbing of finance. For digital dollars, for stablecoins, to really get institutional adoption, they have to solve some basic problems.
Yeah, institutions will not tolerate the chaos of public blockchains.
So that's where Circle's new project, ARC, comes in.
It is. They built ARC as a layer 1 blockchain. Now, for anyone who's not a crypto expert, just think of a layer 1 as the base road, the main highway for transactions.
And it's purpose-built for one thing.
One thing. Making stablecoins work for institutions. They looked at what big firms hate. Volatile fees, uncertain settlement times, and zero privacy. ARC is a private, dedicated network just for moving digital dollars efficiently.
That focus on security and efficiency, we're seeing it in the identity and credit space too, especially with the explosion of buy now, pay later.
Definitely. Look at Secure's acquisition of Clarify. They bought a real-time BNPL credit database, and they're merging it with their own identity and fraud systems.
And what does that do in practice? What's the result of combining all that data?
You get two really important outcomes. First, you can crush first-party fraud. That's where someone uses their real identity to commit fraud. They say this can cut it by up to 70%.
Wow. Okay. And the second thing?
It allows them to give credit to thin file consumers.
Let's define thin file really quickly.
Yeah, these are people who might be totally responsible with money, but they just don't have a long credit history. They could be young or an immigrant or just someone who prefers not to use credit cards.
So this gives lenders a better picture of them.
A much better picture. It's a huge step for real financial inclusion. And MasterCard's doing something similar with their credit intelligence suite.
Right. They're using their own network data, all those transaction signals.
Exactly. They combine that with traditional data to get a much more holistic view of those thin file borrowers. It's faster, it's richer, and it helps banks say yes more often and more responsibly.
And speaking of banks, it's fascinating to see them finally realize they can't build all this stuff fast enough themselves.
The partnership between Fifth Third and Brex is the perfect case study here.
Yeah, tell us about that.
Fifth Third is a huge regional bank, and they just chose Brex for all their commercial cards and expense management. Instead of spending billions trying to build their own system, they're just adopting Brex's.
It's a strategic necessity now, isn't it? It's not just about saving money.
It's about speed. Fifth Third is getting ready for a huge acquisition of Comerica. You can't be trying to build new tech while you're integrating another giant bank. The fastest path to modernizing is just to plug into a FinTech that's already done it.
Okay, let's pivot from that institutional strategy to the wild edges of the market, where culture and finance crash into each other.
And there's no bigger example right now than MrBeast.
I mean, the scale is just hard to comprehend. 450 million subscribers, and now he's launching MrBeast Financial and Beast Mobile.
The trademark filings are serious. We're talking banking, financial advice, a crypto exchange, all wrapped in this friendly financial literacy content.
It's such a risky move for a creator, though.
It's incredibly risky. Regulated finance is not a game. You can't just put your logo on an app. You need deep, complex partnerships for licensing and compliance. It's a huge test of whether that audience loyalty can translate into the kind of deep trust you need for banking.
A huge gamble. And speaking of gambles, let's talk about the implosion of that digital asset treasury trade from a couple of years back.
Oh man, the DEET strategy, that was a classic bubble. Public companies were just buying crypto with corporate cash to pump their own stock prices.
And it worked for a while. Some of those stocks were up, what, over 2,000%?
Over 2,600%.
Yeah.
But the crash has been just as spectacular. Bitcoin itself is only down about 6% this year, but the median DEET stock is down 43%.
43. That is a massive difference.
It's the whole story. Many of these companies are now worth less than the tokens they're holding, and they have all this debt coming due. It's just a perfect cautionary tale. You can't financialize your way to a valuation.
And that brings us to one last shift, a regulatory one that could really impact the next credit cycle.
Yes. The OCC and the FDIC just rolled back the Obama-era leveraged lending rules.
Okay, so what does that actually mean for the market?
It basically frees up banks from some very strict rules they had when lending to companies that already have a lot of debt. The idea is that the old rules were maybe too strict and pushed a lot of that lending business over to less regulated private credit firms.
So this could get commercial lending going again.
It probably will, which is good for the economy in the short term. But analysts are already warning that it could be setting the stage for bigger credit losses down the line when the economy eventually turns.
Right. Always a trade-off. So if we step back, the big themes are pretty clear. Capital is consolidating around scale and AI.
AI agents are reshaping how we buy things, and the actual infrastructure finance is being ripped out and replaced.
So to leave our listeners with one final thought, let's talk about General Catalyst's $1.5 million AI roll-up machine.
Yeah, this is a fascinating strategy. They're targeting the huge $16 trillion low-margin services market.
So a venture fund is acting like a private equity firm.
It's a hybrid. They incubate, they acquire, and then they scale. They aren't just building one startup. They're buying up fragmented industries like logistics or back office services and then using AI to automate everything and slash the costs for the entire consolidated group.
So that raises a pretty provocative question then. If the game is no longer just startup versus incumbent, but this huge AI-powered consolidation engine versus a bunch of small, fragmented players, how much does that change the entire competitive landscape in the next 5 years?
Exactly. And which service markets are next on the list?
Keep that thought close. The very idea of a competitive advantage is being rewritten.
It really is. It's about automation and scale now, not just innovation.
Thank you for trusting us with your attention today. It's a fast-moving world out there, and we hope this helps you stay ahead of that curve. Until next time.
Spoken Tech for your ears.